Everyone thinks that they'll be the one to outsmart the market. Buy low, sell high, skip the pain, keep the gains. But here's the honest truth. Almost no one does it successfully. And the cost of getting it wrong, well, it can wreck your long-term returns. I'm Phil, a certified financial planner and founder of Flying Forward Wealth Management, and I've spent years working with individuals, families, and business owners on their investment strategies, and I've seen how tempting it can be to try to time the market. Today I want to show you why it rarely works and what to focus on instead. So in this video, we'll cover 3 things. Why timing the market seems logical, but usually fails, the real numbers behind missing just a handful of the best days, and what you can actually do to build wealth without falling into this trap. On paper, timing the market makes sense. Get out before things fall, get back in before they rise. I mean, who wouldn't want that? But think about it. You have to be right twice. That's double the prediction power, and markets don't move on a schedule. Major rallies often happen when headlines are still negative. In March 2009, for example, the financial crisis was still in full swing. Unemployment was climbing, banks were failing, and confidence was at rock bottom. That's when the market turned. Did anyone feel like buying then? Absolutely not. And that's the problem. Timing requires you to act against your instincts, and most people, they just don't. We saw the same thing in March of 2020. COVID hit, businesses shut down overnight, and the stock market fell more than 30% in just a few weeks. Panic was everywhere. But within months, the market had recovered, and by the end of the year, it had actually finished positive. The people who sold to wait it out often missed the rebound entirely. Or think back to the early 2000s, the dot-com bubble. Tech stocks collapsed, portfolios got cut in half, and it felt like the world of investing was ending. But those who stayed disciplined, who kept buying through that downturn, ended up owning the same company names that became household names years later. Things like Amazon, Apple, Microsoft. Now let's put numbers to this. Over the past 20 years, the S&P 500 returned roughly 9 to 10% annually if you just stayed invested. Not great every year, but solid over time. But if you missed the 10 best days during that same period, your returns were cut nearly in half. That's the cost of being out of the market for just 2 weeks across 2 decades. Miss the 20 best days, your returns shrink even more, to around a third of what you could have had. And here's the kicker. Those best days tend to cluster right after the worst days. So the time you are most likely to sell after a crash is right before the market rebounds the hardest. Now this isn't just math, it's psychology. We're wired to avoid pain. Losses feel about twice as painful as gains feel good. So when your portfolio drops 20%, your brain screams at you to get out. That's loss aversion at work. You add in recency bias, the tendency to assume whatever's happening now will keep happening, and you've got the perfect recipe for bad timing. Even professionals fall into this trap. Fund managers with decades of experience underperform their own funds because they jump in and out at the wrong times. Now that tells you something. If the pros can't do it consistently, what are the odds that you can? And the real risk isn't just missing out on gains. It's wrecking your long-term plan. Imagine a retiree who sells during a downturn and sits in cash for a year. They might avoid some pain, but they also lock in losses that miss the rebound. Over 30 years of retirement, that one decision could mean running out of money years earlier. This is where the concept like sequence of returns risk comes into play. If you're pulling income during a bad market, selling low makes it almost impossible to recover. Timing the market isn't just risky, it can be absolutely devastating. So what should you do instead? Focus on what you can control. Your savings rate, your allocation between stocks, bonds, and cash, keeping costs low, and most importantly, your behavior. Staying invested, even through downturns, has historically beaten every attempt at jumping in and out. And here's the big picture. The market rewards patience, not prediction. Timing feels good in the moment, but over decades it almost always leaves you worse off. The boring, consistent investor usually wins. That's how you build real financial security, not by trying to be the smartest trader in the room, but being the most disciplined investor. And if this perspective helps shift the way that you think about investing, stick around, because this is exactly how you start to navigate your wealth and elevate your life.